2021, the year for the real estate investor. The 2021 real estate market may be one of those once in a 1,000-year opportunity, folks. It's a lifetime opportunity for real estate investors. No, seriously. I mean, every decade or so, some game-changing event happens that many people are left in the stands and they can't get into the game. I want to get you off the sidelines. I want to get you in the game. So we see a profusion of undervalued properties and widespread financial liquidity creating a perfect storm for real estate investing in 2021. The writing on the wall was when COVID started in 2020. I've been talking about it. It's more front and center now. So it's important to educate yourself as well as your clients about these market changes. So maybe you can cash in on some opportunities that are in front of you. So let's look at some reasons why, what's going on in the market. When we talk, number one, we all know the pandemic has created a new game, new real estate investing opportunities for sure. COVID has changed one real estate fundamental forever. Absolutely. In the past, many long-term investors focused on investing in areas with strong employment. Makes sense, right? Recent thinking was, hey, strong employment is going to attract people. If you attract more people, that equals higher rents. What does that mean? Higher rents results in higher what? Property values. Yes, that's true. But even before the pandemic, that was true. We saw, a steady shift in some workplace towards virtual and remote work. And COVID-19 accelerated this transition for both employers and employees. The rapid growth of remote work has expanded the options for savvy real estate investors as employees move away from the urban centers and opt for less crowded, more affordable rental markets. However, let me just say this. I am optimistic, and I've always said this about the city centers. I'm not a believer in it's going to be a mass exodus from the cities. I don't think that humanity is going to change our stripes. We've been urbanizing here for over a century, and I do believe that people like people generally, and I think there's a lot of information to show that. You're going to see people, maybe 3 days a week working from home and then going back to the city centers. There's a lot of benefits of people being together, So I do believe that. So more people are working from home. The 2020 survey by Major Investment Bank in Chicago found that 50% of the executives expect that many, if not all, their employees will remain remote after the pandemic. I hope that's not true overall. The migration patterns are changing. Remote work is here to stay, and many Americans are gravitating to places with lower housing costs where they can afford larger homes and enjoy a better quality of life. So another reason is more inventory is coming. I do believe that. Why do I believe that? I think, I know what you're thinking. Hey, Tim, there's not enough inventory already. How am I going to find properties for investors to buy or myself? Well, the good news is that inventory is due to increase and the opportunities to buy these properties won't be limited to rural areas in our opinion. In addition to creating new migration patterns, the global pandemic has also pushed the U.S. economy into a massive recession, and the can is just being kicked down the road, and some people don't see it in front of their eyes. While this recession has impacted the real estate market, there is a very good chance it will in the near future. So the writing's on the wall. Why? Let's look at this one. We've been talking about this. Extension of the forbearances. Guess what? It's ending. There are currently more than 3 million. Some people are saying 2.3. I've heard 2.7. I think it's over 3 million homeowners in forbearance on the mortgage. 100%. Amazingly, this doesn't even reflect private mortgages that are not insured by good old Fannie Mae and Freddie Mac. So forbearance balances, the total amount of money homeowners deferred paying under forbearance agreements may become a nightmare for some homeowners. For example, if a borrower asked for forbearance when this started, March 2020, and extended it into September 2021, they would have occurred 18 months of missed payments. 18 months of missed payments. So the reason this situation had become a nightmare for homeowners is that at the end of the agreed forbearance period, guess what? The suspended payments are due in one of 3 ways. So you could pay it in a lump sum payment, short-term repayment plan, or a loan modification. Banks not going to do, the banks in 2008 said we're going to help people out. They double dipped and took that $36 billion of real estate. So these all give me heartburn. In 2008, the banks did not help people and foreclosed on their homes. So the bottom line is the money's going to have to be factored back into the loan some way, shape, or form. They're not going to forgive this, folks. So jobless benefits, what's happening there? They're expiring. That federal benefit, the $300 per federal employment benefits under the COVID-19 relief plan are set to expire when? September 6, roughly 2021, with no current plan to extend it. This extra money is going to keep some American households afloat for a little while, and the resulting reduction in the household income will impact families who are already struggling to keep up. So reasonably, we can expect this will cause more borrowers to start missing mortgage payments, and the housing inventory is likely to increase as more families are forced to sell to avoid, unfortunately, foreclosure. So what's happening, ladies and gentlemen? The moratorium of foreclosures and rentals will eventually end. 4 million people are facing eviction. So this can's being kicked down the road. So all this means is very, possible by late 2021, early 2022, tens of thousands of homeowners will be forced to sell their homes to avoid foreclosure, and landlords will be behind on their mortgages. Landlords right now are behind on their mortgages as well. I know that for a fact. Look for deals in multifamily buildings as well, not just single family. The numbers may reach into the millions. And those savvy investors are on top of their game who see the forest through the trees should prepare for the unique opportunity by building a plan and organizing their finances so they can be ready to pounce when these homes come on the market. We all been talking about another issue, another reason, the historically low interest rates. When we go back to the 1980s, the median U.S. home price was roughly almost $65,000, $64,800. But the price isn't the only factor that investors should consider when deciding on the right time to buy. Though prices were low in the 80s, investors' qualifications were more stringent. The mortgage payments were higher and cash flows were very tight. Mortgage rates were over 13%. Remember that? And required the borrower to pay 2 discount points just to get that rate. So low interest rates can have an attractive incentive. Today, interest rates are below 5%. If people don't get below 3%, they're going to cry now. So investor qualifications are still very favorable, and cash flow can still be found in outlying areas. This is huge. I have always said this. Listen up. I have mentors. I've had mentors in the 70s and the 80s and 90s, and I wasn't listening in the 70s and 80s. I was too young, and even in the 90s. And have always told me, buying rental properties is an excellent hedge against inflation and volatility of the stock market. People always need a place to live, and you want to touch that building. So the downside of low interest rates is that they can be a driving factor in inflation, which can also be impacted by the government increasing the availability of money. Inflation is the devaluation of the dollar in comparison to the goods and services we buy. Get ready for that digital currency. Generally, the more money that's injected into the market, which we're doing at an unbelievable pace right now, the higher the prices for goods and services. So another issue, your clients don't have to wait for the market to fall to invest. I made this mistake. Many people feel that the real estate market may be at a peak and that investing now is a huge mistake. But if you take into consideration the bigger picture, now many, maybe probably the best opportunity in decades for your clients to invest. Timing the market rarely works. It's hard to time the market. I can't do it. I've tried and it never works. So neither can you. Here's why. Some markets still appreciate during recessions. Yes, they do. I wasn't aware of that back in the early days, and not all housing markets lose value during a downturn. Many housing markets appreciated throughout the 2008 recession in cities like North Carolina, Fayetteville, North Carolina, San Francisco, California. So this is mainly due to strong employment sectors that included what? Military, government, technology, which weren't as greatly impacted by the downturn. So the new work from home economy and shifting migration patterns may mean that your markets won't be as severely impacted. Look at it from that angle, study that. So by the shift as other markets might be affected. So fewer financing options. One caveat is that loan qualification requirements changed drastically from 2007 to 2009. Banks required higher down payments and put restrictions on the number of investment mortgages a client could have. So they also extended rental income to offset debt to income ratios. Therefore, it is very possible that your client may not have been qualified to buy an investment property between 2008 and 2014 when the restrictions were fully loosened. So had your investor waited to buy at the bottom and were not able to, they would have missed out on more than 5 years of appreciation. And that is why the best time to invest in real estate, folks, is what is always now. The best time to invest in real estate is always now, and I wish I knew that early in my career. Long-term buy and hold is your client's best strategy in real estate for sure. Warren Buffett, he coined the phrase, he believes it in the stock market. If you're not willing to own a stock for 10 years, don't ever think about owning it for 10 minutes. I'm sure Warren's been in some stocks for 15 minutes and pulled his money out. The same can definitely be said for real estate, though. Long-term investment strategy, my dad believes in this. He's holding properties for 20 years, 30 years, can protect your clients from short-term fluctuations in the market. Focus on educating your clients to look for properties that have cash flow. It's all about the cash flow, not what the property's worth, and long-term upside potential. These are the properties that will be proud to still own in 10, 20, 30 years. So, another reason, folks, home prices are going to continue to rise. It's no secret that houses appreciate over time, but many people allow short-term fluctuations to prevent them from entering the real estate market. Real estate professionals know, you guys know the power of appreciation over an extended period of time, such as 20 to 30 years. That thinking is exactly what will allow you to attract more real estate investors and yourself being a good investor in turn, clients into investors and allowing you to put more properties in your portfolio. So America's housing supply and demand, the direct cause of housing demand is the population is still growing, folks. It's growing from both natural increase, the net of births, less deaths, and migration in given areas. So housing supply is the existing safe and functional housing in the area. Supply can only be increased by adding new housing, or if demand increases, making existing homes available. That is key. When demand from both buyers and renters outpaces the supply, current available inventory, home prices and rents will rise, and that is happening. So let's see how these two factors kind of project and how this kind of works out. U.S. population growth is going to continue to drive demand. Absolutely 100%. One of the main causes of appreciation housing market is a growing population. We are growing massively in population. When an area loses a population and there are more homes than people to fill them, then the home values will fall. The U.S. net population is determined by 3 factors: birth rate, death rate, and immigration. If the population in America continues to grow, housing prices will also continue to rise. However, if the population decreases like it did in certain areas, Detroit, home values may likely fall. So by 2030, remember folks, 2030 is the big year. Immigration is due to surpass the natural population increase. And by 2060, the U.S. is slated to reach a population of 400 million. We're 330 now, putting enormous pressure on demand for housing. Unlike in Detroit, U.S. Housing prices are expected to steeply rise for the foreseeable future. Another reason why you should convince yourself and your clients to invest now is to capitalize on the unique economic conditions. So another issue is new construction cannot keep up with demand. So the simple solution is to solve the problem of lack of supply is to just build more affordable homes. So if only it was that simple. Gone are the days of buying land and building a few low-cost homes in just a few months. Fewer home builders today, real estate markets fluctuate, leaving home builders at risk of losing millions of dollars, and they're a little more careful than they were in 2008 if the market shifts before their projects are completed. Nearly 50% of the home builders did not return after the recession in 2008. Since then, new construction has continued to trail. So there is an uptick, especially in the last year, a 12% increase, but they got to start cranking away. So rents will continue to rise. That's another reason. Rents are going to go up. The U.S. housing market is reaching a new phase that many other countries are already experiencing, a phase where the American dream of owning a home may not be achievable for the majority of Americans, especially millennials, forcing future generations into rental housing. That is happening. Renting for life, cradle to grave, homeownership rates declining. With homeownership rates at 63%, the U.S. ranks in the bottom 20% of countries when it comes to home ownership. Home ownership in other developed countries like Germany, 53%, Britain, 56%, France, 63%, are also low in comparison to countries like China, 89%, and India, 86%. So bottom line, declining homeownership and a growing population will put pressure on the rental market, and there is really only one solution to this problem, but we're not likely to see it happen here in America, I hope, is high-density, low-income rental apartments. The main cause of rising rents is the low supply of affordable, high-density apartment-style rentals like the ones we see in countries like China. It is doubtful that most American cities are going to start building affordable apartments to keep up with the population growth. So, population growth San Francisco is experiencing today. Other cities will also find themselves with unaffordable homes to buy and increasing in high rents. So, in sum, despite a short-term recession, the house values and rents will continue to rise, while we will see some inventory increase due to some homeowners being forced to sell. It's going to happen. The inventory will be absorbed quickly, and the U.S. will soon return to a highly competitive housing market. So I think COVID will create a unique but brief opportunity for you to invest for yourself, your clients. It's just very interesting times. You have to think between the lines. So I would be careful, but I would be hopeful. This forbearance and moratoriums, when they end, they kick the can down the road, folks. If these people were foreclosed on tomorrow, we would be in a biblical crisis worse than 2008. And there is some things with the new administration with these high density homes. I'm a little concerned about that. I'm going to do a talk on it. There's some new legislation in the pipeline in the rural areas, but there's political reasons why they want to do it, and I understand it. The political game, as far as one side wants to do it and the other side doesn't. To mirror what's going on in China. So I have a little heartburn with that. I'm not sold 100% that that's not what some people want to try to do in the rural areas. So get into the investing game. It's just not about the stock market where money's floating around. You want to touch that hard asset and get some cash flow. Take care. Be creative.